I think there's also an issue about concern about what's happening in the U.S. as well, particularly in terms of government shutdowns, the issue whether the trade war will get out of control. All of those things are also weighing on them. But what I think was so interesting here was that they also actually are less worried about inflationary pressures. And I think that's key. From their viewpoint, having an economy be very strong, if there's no inflationary pressures, is just fine with them. Given the uncertainty, they then basically took a decision to pause.
Rick, Peter Bookvar from Bleakley Advisory writing that, quote, the bottom line, while the Fed, I believe, clearly had room for the current pause because of the economic slowdown going on overseas, it should also be clear to everyone that they are mostly beholden to asset prices, both the stock market and credit spreads, with that driving policy. Do you agree?
Yeah, I think that's actually overstating it. The Fed certainly looks at what happens in terms of asset prices because it does feed into what happens in the economy. But actually, it's very bad policy for a central bank to just follow what the markets are telling them to do. And the Fed doesn't want to do that. It's more that there's some concern in the markets, but we also see that the Fed is accessing the situation in terms of both the geopolitics, what's happening abroad and what's happening here. And they basically see the need to wait and see. This doesn't mean that they couldn't be raising rates in the future. A lot of the uncertainty that they're very concerned about could go away. That would actually be a good outcome. But on the other hand, it could also get a lot worse, and then that would make it more likely that they would want to start reversing direction.
Rick, what do you make of the fact that it seems to be suggested from these minutes that the balance sheet reduction will be completed this calendar year?
So I think that this is a technical issue for them. This is not a monetary policy issue. Very important in terms of discussions of the balance sheet is that they don't want to see this at this particular point as a monetary policy tool. If the situation is normal, they want to conduct monetary policy by changing the federal funds rate and talking about where it might be in the future. That's sort of the standard way of doing monetary policy. The only reason they would then want to use the balance sheet is something really bad happens, where you need to do this non-conventional quantitative easing as they did in the past. That's not, I think, what's going on. What's going on is that they basically have been doing an assessment of the best way to actually conduct monetary policy and the way to basically control the federal funds rate in the best way. And their conclusion from this analysis is that they actually would like to have a lot of excess reserves in the banking system. They think that's a better way of doing monetary policy. And they revised upward the amount of excess reserves they want in the system to make this actually work the best way possible. So I think it should not be interpreted as a monetary policy move, but in fact much more as a technical move in terms of the best way for them to conduct policy.